So what if I told you that you can instantly reduce your taxes by simply taking money that you already have and moving it into an investment that you already need? A lot of people do not know this, but the tax code literally grants you tax deductions for making certain types of investments. Now we call them tax deductible investments, which allows you to do two things. Number one, build wealth, and number two, reduce your taxes all at the same time. And as a licensed CPA at mycpacoach.com, I have personally saved my clients 6 to 7 figures in taxes by simply taking advantage of the investments that you are going to learn in this video. So go ahead and save this video, comment below if you have any questions, and make sure you subscribe for more guidance to less stress and lower taxes. All right, so as we go through this, remember, your tax is solely based on your income. Your tax rate increases as you earn more and more income. But when you make tax deductible investments, you are pushing income off of your tax return for this year. For example, let's say that you earn $100,000 in income and made a tax deductible investment of $20,000, making the entire amount tax deductible. Well, in that case, that $20,000 investment will lower your taxable income to just $80,000, which would save you $4,400 in taxes if you were in a 22% tax bracket. Now, the more income you earn, the higher your tax rate will be, and therefore the more beneficial these tax deductions will be for you in those scenarios. For example, a $20,000 tax deduction will save someone in a 37% tax bracket about $7,400 in taxes. So as you can see, your tax savings will depend on your income and your tax bracket. Now, with that said, let's go through the various types of tax deductible investments, starting with the very easy ones, and then we will gradually get into some bigger investment opportunities and types. So let's jump in. Investment number one, your traditional IRA. Now, if you don't know, an IRA simply stands for an individual retirement account. And the good news is that literally anyone can set this up at a brokerage for free, typically at a place like Fidelity, Vanguard, TD Ameritrade, and so on, as long as they have earned income. Now, let me be clear, this does not have to be done through a job, an employer, or a business. An IRA is an individual account that you can set up yourself. So here's how it works. Right now, you can contribute up to $7,000 to a traditional IRA or $8,000 if you're above the age of 50. And when you do, you will receive a tax deduction for it if you qualify. And this is per person. So if you have a spouse, that person may also be able to get another $7,000 to $8,000 into their account. You can even set this stuff up for your kids. And again, that's another $7,000 if that child has earned income. Then once you have these accounts, you can also invest into various assets like stocks, bonds, CDs, and other assets to build up wealth until the point in which you retire. And as those investments grow in value, you would pay no tax on them. You can even buy and sell investments in these accounts and it still will not trigger a tax bill. You would only pay tax when you start taking money from these accounts, which you can start doing once you turn 59 and a half if you choose to do so. So if you are in a high tax bracket today and expect to be in a lower tax bracket when you retire, you will instantly reduce your taxes by moving funds into a traditional IRA. Now, there is one big caveat to this, and that is that your deduction can be limited or disallowed if you are covered by a workplace retirement plan, such as a 401k, for example. For instance, single taxpayers with incomes above $87,000 and married filers with incomes above $143,000 will receive no tax deduction if they are covered by a retirement plan at work. So be sure to consider your income and your 401k benefits before setting something like this up. And speaking of 401ks, this actually perfectly leads us to the next big tax deductible investment here, which is number two, your traditional 401k. So a 401k is very similar to an IRA, except a 401k is set up through a business and has much higher contribution limits, which means greater tax deductions and, more importantly, lower taxes. You can take advantage of a 401k plan through your employer, or even better if you have a trade or business, because you can set one of these up through that as well for even more tax benefits. So here's how a traditional 401k works. As an employee, you can put up to about $23,500 of your wages, or $31,000 if you're over the age of 50, into a traditional 401k account. And thanks to the Secure 2.0 Act, taxpayers between the ages of 60 and 63 can put up to about $35,000 of their income into a traditional 401k. Now, regardless of the amount that you decide here, because all of this is voluntary, what you need to understand is that once you put money into a traditional 401k, you are creating a tax deduction that is equal to the amount that you put in it. Or in other words, you pay no tax on that portion of your income. You're instantly reducing the income that would otherwise appear on your tax return for that year. And by the way, that's just the employee side. Then the employer could also add up to another $46,000 or so towards your retirement account in 2025, depending on how their plan is designed, which they would be able to deduct. But that also means that if you operate your own trade or business, even if it's just a side gig, then you could also take advantage of that same employer contribution limit. For example, you can set up a solo 401k or SEP IRA through your business, which would allow you to put up to 25% of your business income towards your retirement as an employer up to this limit, which would only reduce your taxes even more here. Now, with that said, regardless of the number and the amount and types of 401ks that you use, they all share the same maximum employee limit and the maximum employer limit. So if we added both of these limits together, the maximum that any individual could put towards their own 401k for 2025 is as follows: $70,000 for individuals under the age of 50, $77,500 for people over the age of 50, or about $81,000 for individuals between the ages of 60 and 63. And remember, this is per person. So if you have a spouse, then they would have the same opportunity to use these same limits to create even more tax savings on your tax return. Now let's talk about something else. Number 3, health savings account. Now, a health savings account, or HSA, is another account where you would receive a tax deduction in exchange for putting money into it. But unlike retirement accounts, you can actually spend the money in this account on qualified health expenses that you may already pay for. So like doctor visits, dental visits, chiropractic care, and even massages, and so much more. So this is how it works. If you qualify, you can put anywhere from $4,300 to $8,500 into an HSA depending on your filing status, whether you're single or married. And when you do, 3 things happen. Number 1, you will get a tax deduction for the amount that you put in your HSA. And number 2, like we mentioned, you can invest these funds in your HSA into other assets like stocks or bonds. And number 3, you can spend your HSA funds on qualified health expenses. And when you do so, those funds come out tax-free. So if you use your HSA correctly, you can effectively never pay tax on the money that you put inside that account. Now let's cover one more type of investment account that you can use to reduce your taxes, and then we're going to level this up here and get to some more advanced stuff. Number 4, donor advised funds. So if you already give money to charity, or you plan to, then you can supercharge your charitable tax deductions by investing into a donor advised fund. Now, this is basically like a piggy bank to fund your future charitable giving, like a savings account. And you can easily set something like this up for free at Fidelity. So here's how it works. In general, when you give money to any charity or a registered nonprofit, you receive a tax deduction in the year that that charity received your donation. But when you move money into a donor advised fund, you would receive an immediate tax deduction based on your contribution, not when the charity receives it from that donor advised fund. So in essence, you could move a large lump sum of money into a donor advised fund to create a massive tax deduction in this tax year. And then you could choose to give the money in that fund to charities over whichever period of time that you would like, whether that be in 5, 10, 15, or however many years. Now, in addition to that, you can invest the funds in this account to grow the balance over that period of time as well. Now, while the amount that you move into a donor advised fund is eligible for a charitable tax deduction, please keep in mind that donations like this are considered itemized tax deductions, and most people take the standard deduction by default on their tax return. So typically, in order for something like this to make sense, you would need to already be taking the itemized tax deduction on your tax return, meaning it is already more beneficial than the standard deduction for you, or you're planning to move such a large amount of money into your donor advised fund, so large that you end up qualifying for the itemized tax deduction anyway. And lastly, please keep in mind that because this is a charitable account, the money must go to charities. You cannot use it for any other purpose once you deposit funds in it. All right, so now that we've covered some of these simple account structures that will give you a tax deduction for simply moving money into it, now let's get into some specific assets that provide even larger tax deductions. Number 5, a small business. So not only is owning a small business one of the fastest ways to build wealth, but it is also one of the best ways to reduce your taxes. And this is because business owners have the ability to pay taxes after deducting all of their expenses, whereas most people pay their taxes first and use whatever is left to pay for their lifestyle expenses. But by deducting expenses first, business owners are able to report less income and consequently pay less taxes. And the tax law allows business owners to essentially write off almost anything as long as it has a business purpose. You can write off a portion of your mortgage, your rent, your utilities, vehicles, food, health expenses, travel, and so many other expenses as long as there is a business purpose associated with it. Plus, the tax law even allows you to write off the expenses that you incur to start and grow your business. The IRS allows you to write off your startup costs, your legal costs, advertising expenses, research and development costs, and so much more. These tax deductions can result in tens of thousands of dollars in tax savings alone. But if that's not your cup of tea, let's move on to number 6, short-term rental properties. Now, real estate is widely known as one of the best tax shelters in the world. You can qualify for very large tax deductions when you buy real estate, and you can even avoid taxes when you sell your real estate. Plus, on top of all of that, the tax deductions can be so large that it offsets other income on your tax return, like your W-2s or business income. And that is why so many people choose to invest into specifically short-term rental properties to instantly reduce their taxes. Because unlike other types of rental properties, tax deductions and losses associated with short-term rental properties qualify as a business activity, which is a key distinction here that allows your deductions and losses to offset other income like your business or W-2 income on your return. Okay then, so how does the IRS define a short-term rental property, and where exactly do these deductions and losses actually come from? Let's go ahead and break this down. So the IRS defines a property as a short-term rental when the average period of time that a guest stays there is 7 days or less. It's that simple. And as far as deductions go, there are several when it comes to real estate, but the biggest one is depreciation. This is a non-cash expense that allows you to write off a portion of your property costs each year, sometimes allowing investors to write off literally 20 to 30% of their property in 1 year, depending on how they choose to take depreciation. But in addition to that, because these types of rental properties are treated as businesses, you are also able to deduct all expenses connected to these rental properties, such as the mortgage interest, property tax, insurance premiums, utilities, repairs, and many other expenses if they are incurred to conduct your real estate trade or business. And because of all of these deductions and depreciation, real estate investors are often able to report losses on their tax returns despite earning rental income from their tenants. Number 7, long-term rental properties. Now, long-term rental properties technically have the same ability to enjoy all of the tax deductions that we just covered. However, there is one key difference. Rental income from long-term rental properties are generally considered passive activities, not business activities, which is a key here because passive losses and deductions can only offset other passive income. And once these deductions offset all of your passive income, generally only $3,000 of your remaining losses can be used to offset other income you have from your business or from your employer unless you meet certain criteria. And that criteria is either A, qualifying as a real estate professional, which is simply a time requirement for the most part. You don't need a license or real estate certificate for this at all. You just have to work at least 750 hours in real estate activities in which you materially participate in, which comes down to be like 10 to 15 hours per week. And then most of the services you personally perform must be in real estate as well. Now, if you do not meet this requirement, you can also qualify your rental property as a business activity if the property is used for a business you own, like an office, a warehouse, or something that is being used for a business that you are a part of. But if none of this is possible, then you can still significantly benefit from your long-term rental properties in the sense that it will at least limit your passive income. But if you want more tax benefits, consider a short-term rental business or this next investment opportunity here. Number 8, oil and gas investments. Now, this is something that has very large tax benefits that simply is not talked about enough. You can invest money into a private oil and gas company and write off 65 to 85% of your investment in the first year. Now, oil and gas is used in so many ways here on a daily basis, from fueling our vehicles to heating our homes. And when you make an investment into an oil and gas company that conducts drilling, you get 2 huge tax benefits. Number 1, similar to real estate, oil and gas companies are able to take very large amounts of depreciation, which creates a massive tax deduction for them. And number 2, this tax deduction automatically qualifies as a business activity and can easily offset other income on your tax return. So in some ways, the tax benefits of oil and gas are even better than real estate, because as you saw here, in order for real estate losses to offset other income on your return, you have to be highly involved in the day-to-day operations and meet very specific requirements. Whereas with oil and gas investments, you do not have to be involved in the day-to-day operations at all and do not have to meet very specific requirements for your deduction to offset other income on your tax return like real estate. But to be clear here, the type of oil and gas investments we're talking about are not stock investments on the public stock exchange. These are typically private partnerships that conduct drilling operations and allow investors to invest as general partners in their business. And because of the nature of this, these investment opportunities are typically limited to accredited investors. Now, I have separate videos that go more in depth into every single investment strategy that we've covered so far, so be sure to subscribe to our channel if you want to learn more. And if you want a tax plan that is guaranteed to reduce your taxes, just go to mycpacoach.com to apply to work with one of my CPAs today.